taken 4 years of ropey share prices, but emerging markets have finally given back all the outperformance against the developed world that they generated amid the Chinese rebound of 2009 and 2010. Now, it's fair to say that there's a bear market in emerging markets, and that isn't just because so many countries are in difficulty, from Brazil and Turkey through to South Africa and, at least in its stock market, China. The MSCI Emerging Markets Index remains 22% below its May 2011 peak, which was hit at the peak of optimism that the world was recovering from the Great Recession. Now, to be fair, it's worth pointing out that it took developed markets a couple of years to get back to where they stood at that point in 2011 as well, thanks to a combination of doubts about US politics and the near collapse of the Eurozone. But since then, the developed world, that's the blue line on here, has been storming ahead, finally passing the emerging markets when priced in dollars pretty convincingly earlier this month. That's with both of these showing that dividends are reinvested. Now, both the developed and the emerging market index hide a lot of variation, with the US, Europe and Japan facing very different problems, just as Russia, Korea and Turkey face very different problems. But so much money is tied to the overall indices that it is worth treating them as a single lump in spite of these differences, particularly when considering moves in the dollar, the world's reserve currency. Now, to some extent, the rest of the developed world has some protection against dollar shifts, with the yen, euro and sterling being minor reserve currencies in their own right, but more importantly, with developed country debt mostly being denominated in its home currency. A strengthening dollar ought to be good for shares in developed countries outside the US, as the share prices rise to offset losses from their falling currencies. Now, historically, emerging market governments tended to borrow in dollars, and while thankfully that's changed, their corporates tapped the dollar debt markets in a big way over the past few years to take advantage of cheap loans. Now, that leaves them exposed to a stronger dollar, potentially hurting share prices if the greenback keeps going up, and at the least ensuring that they rise by less than their currencies weaken, hurting returns for dollar-based investors. Even worse, both emerging markets and their stock markets are more heavily exposed to raw materials, which of course are priced in dollars, than developed markets are. So that hits emerging markets with a double whammy when the dollar rises. Now, the historic pattern has been pretty clear and it's been continuing recently. The stronger dollar, that's the red line here, using an inflation-adjusted broad measure of the dollar against a basket of other currencies, that dollar has moved almost exactly opposite direction to the performance, the relative performance of emerging markets. So when the dollar's doing well, as in this period, emerging markets underperform. So relative to developed markets, this is showing emerging markets falling, and then emerging markets do better when the dollar is weakening. Now, one hope for EM is that a stronger dollar will result from a better US economy, which will suck in imports and so help EM exporters. But in the past, extra US demand's been more than offset by the problems that a strong greenback creates for borrowers in emerging countries, as well as by the better performance of the US and other developed world countries, which tend to supply more of the finished goods and services that US consumers want. Now, this time should be at least a bit different, dangerous as it is to say that, because most of the dollar pegs which caused the EM crises in the 1980s and 1990s have been replaced by floating currencies. That means you get a smoother adjustment to a strong dollar rather than the collapses that we saw with the tequila crisis in Mexico or the Asian crisis which started in Southeast Asia and then eventually spread to Latin America in the 97, 98 and the Russian default. Equally, of course, the dollar might not actually rise that much further. After all, the markets have repeatedly been wrong about Fed rate rises over the past few years. Maybe this time they're wrong again. But probably the best hope for the emerging world index investor is that EM stocks are really quite a bit cheaper on pretty much every measure than their counterparts in the developed world. As an example, the median emerging market share trades at 13 times forecast earnings compared to 17 times for the developed world. so that offers at least some cushion against further underperformance.